Hi everyone, it's January 2026, so Happy New Year to you all. Payday Super, it's coming in July. It's been pushed back and held off for COVID and other things, but it's now happening. And so as an employer, you need to get behind this and understand what the changes are going to mean. Why do we need to look at it now? This is the biggest change to superannuation since it was implemented, the compulsory superannuation, since it was implemented in the mid-1990s. Biggest change. You need to know what those rules are. You need to know how it's going to change your day-to-day operations. And for some of you, it will be quite a significant change. It's also going to have an impact on cash flow. It's not going to cost you more. It's just going to really change when your cash needs to be paid for your super, for your team, etc. All right, so I was going to do a webinar on this. It seems like January is perhaps a little bit too soon for you all, so I thought a recording would help. You can have a look at this in your own time and then reach out to me for how this is actually going to impact on you specifically. So let's just go through some of the basics of what's changing. First of all, under the existing super rules, we pay superannuation, compulsory superannuation for our employees on an amount calculated on ordinary times earnings. It means their basic wages, excludes overtime and excludes termination payments when a staff member leaves for whatever reason. It is payable on bonuses, except in very, very, very rare circumstances, but it's not payable on overtime. Under the new regime of Payday Super, the terminology will change and it'll become qualifying earnings. It's fundamentally just a change of language, and the ATO is known for changing the language when they change the regime around it, purely because it helps everyone to know what rules applied based on the language that you're using. If the language stayed the same, then it's a bit harder for everyone to sort of really know what's going on. So fundamentally, that's just a language change, so don't be too concerned by that. Ordinary times earnings, or OTE as you may know it, is now going to be called qualifying earnings. The biggest change, perhaps the most worrying change, is the frequency of when you need to pay the super. So at the moment, some of you may be paying it monthly or quarterly. Most of us are paying it quarterly. Under the new rules, super will be payable for your staff the day that you make the payment, and you have 7 days to get that from your bank account to your employee's super fund account. 7 days is the processing time that your clearinghouse, banks, etc. have to do it, and you have to pay the super on the day that you make the payment to the staff member. All right, so if you're struggling to come up with the cash flow to make payroll, you're going to struggle to come up with the money to pay the super as well on the same day. It's always been a bit contentious about how long it takes for clearinghouses to process your super and get it to the employee super fund. The legislation is being changed so that these clearinghouses don't have the option to sit on the money for any length of time. They have to make it all happen rather quickly. So we'll see how that works out. There are a couple of exceptions to that payday super being paid on the same day as payday, and I'll come back to them a little bit shortly. Another big change is how the maximum contributions are being calculated. Most of you are probably aware that the annual superannuation contribution at the moment is $30,000 per employee. Above that, they pay extra tax from their super fund. Up till now, there's always been a quarterly cap on how much super there's going to be. So if you've got an employee earning large amounts, maybe it's yourself, if you were going to exceed the quarterly cap for that super in that quarter, then you don't pay the extra super. You just pay up to the cap. We've got a couple of you that we manage this for, and this will change so that it becomes an annual cap. Now, this will mostly impact those of you that pay yourselves a bonus, because instead of just getting to the end of the quarter and saying, right, I've gone above the wages cap, I only need to pay my super up to this amount, you now have to have a look at what you've been paying every quarter. Excuse me. So what will this mean? I would expect that the super fund, the payroll software will update their system so that we will have that tracked for you, a little bit like they do for the under 18s and things like that. I haven't seen too many of the programs doing it yet but they've got a lot of payday super things still in the works. So I'd like to think that this would become one of them. It will mean, though, that you will end up paying more super for these people if there's bonuses. At the moment, if you get a bonus in one quarter, then it might take you over the cap and you just cap how much super that you pay. But if that bonus is now averaged over the whole year, you will end up paying more super on it. So you need to be aware of that if you've got bonuses or performance bonuses or equity sharing going on with any of your employees. And if you do, please reach out so that we can have a talk about this. Okay, it's going to add to your costs. All right, there's 2 exceptions to the 7-day rule. The first one is for a brand new employee. You've got 20 days. Now, remembering that you're needing 10 days of that for the clearinghouse to process it, so it's only giving you an extra 10 days to do that. And that gives you that little bit of extra time to get the stapled super for your employee, or for the employee to fill in their details and give you their choice of super fund. The other exception is if there's an out-of-cycle earnings payment made to someone, you can then catch up the super on their qualifying earnings on the day that is the normal payday. So if someone gave you their payroll information too late, or if they got a bonus, or you missed something in a payroll and you had to give them a bit of a catch up or anything like that, when the next payday is done, you can do that. You can make the payment to the super then. Okay. They're the only 2 exceptions at the moment. Whilst we're on it, I just want to cover off on the requirements around who you have to pay the super for your employees. So at the moment, we've got a little bit of a hierarchy of decision making that you need to make. And the first one is you need to give them a choice of super form. All right. It nominates who their super will be paid to unless they give you the form back. Most people now are filling it in, but nationally, the statistics are actually quite low. So if they give you back a choice of super form filled in, nominating who their super fund is that they want to be used, that's the fund that you need to give it to. And most of us are across that rule, and we know that that's the requirement. However, most employees don't give you one. And I've lost count of the number of times an employer has said to me, oh, I can't pay their super yet because they haven't told me which fund. That's not how the rules apply. What we need to do is to then go to stapled super. So you can do that through your online services, Business Online, or you can contact us and we can lodge a form through the portal and get that for you. Usually it's pretty instantaneous. We can't lodge the form until you've lodged a payroll. So thankfully, we're going to get a 10-day extension for new employees. So if you get to payday and you haven't got any super details for them, make the payroll, lodge the STP and ask us to give you the stapled super details. We'll then get onto the portal, get those stapled super details for you and send it back to you, or update your data file for you, whatever's easier. And then you've got their super details and then you can make that payment. And you've got an extra 10 days up your sleeve, so we should be able to manage that quite easily. If your employee is new to employment in Australia, such as a school leaver or an immigrant just arriving, they might not have a super fund. So choice of super fund is not form is not going to get filled in by them. And secondly, they're not going to have any stapled super for us to find out. So what are the rules that you're meant to do when that happens? And that is your default super fund applies. All right, so if you're in an industry or your awards stipulate what fund it might be. So if you're in retail, they might recommend REST. If you're in hospitality, they might recommend, or it is a requirement for Host Plus, then they might be your default super funds. And if your employee does not tell you who they want their super fund contributions to go to, and you can't get any stapled super information for them, it has to go to your default fund, and you put that into your clearinghouse or into your payroll software, and they will then set up the details. So all the details of the identity of your employee goes to that super fund, and they then contact the employee and set them up. That's not changing with Payday Super, but it's going to become more critical that you understand how that circumstance works, because you've got a lot less time up your sleeve to sort it out. But saying that you don't have their super fund details from the employee does not remove your obligation to pay the super. So there is a mechanism to go around that. All right, Now I'd like to just discuss with you a couple of the consequences of not paying the super on time, i.e. on payday. In the past, it was always calculated quarterly, and obviously under this new rule, it's going to be calculated weekly or fortnightly depending on your payroll is. In the past, you needed to lodge an SGC shortfall statement when you were late paying it. We've been pretty good at capturing that for people and making sure that you're getting that lodged as quickly as you can because it minimises your interest and penalties. But under this new system, it's going to be, let's work on someone that's got a weekly payroll, it's going to be weekly. There's no SGC statement, shortfall statement to lodge anymore. It'll actually come from the ATO, okay? So saving a little bit in accounting fees, not having to fill in the shortfall statements, but you're also now dependent on the ATO, and they will know when your super is short because the super funds are reporting to them and your STP is reporting the information that's necessary for them to know when there's a shortfall. So I'd expect that their systems will be pretty efficient in getting it back to you pretty quickly. Under the current regime, you would pay the super, you would pay an admin levy of $20 per employee and then $30 per form for the ATO to process it, and an interest component that's backdated to the first day of the quarter. If the ATO identifies the shortfall before you notify them and lodge your shortfall statement, then there's also a culpability component of 200%. Now, in that regime, the current one, none of those payments are tax deductible. You've lost the deductibility for the super that you paid late, and that hurts. Under the new regime of payday super, the super paid late and the admin fee will be deductible. The interest will not be deductible because that's the new rules that came in on the 1st of July 2025, that no interest payable to the ATO is tax deductible any longer. So that continues with this as well, but the super and the admin uplift fee will actually still be deductible. The admin uplift fee will be calculated slightly differently than under the current regime. So instead of being $20 per employee and $30 to lodge the form, in which case if you had 2 employees with late super, then it would cost you $20 each and then the $30, so it would cost you $70 all up in an admin fee. Under the new system, this admin uplift will be calculated at 60% of the shortfall amount. So probably, I don't know, in some circumstances it might be higher, sometimes it'll probably be less than the old system. All right, but it's 60% of whatever is the shortfall, but it will be deductible. There will be interest on the entire amount that's outstanding, whereas under the existing system, it's actually only on the shortfall amount that's outstanding. So the interest will be higher. The other thing to note is that if the super remains unpaid for 28 days, the ATO will issue you with a notice to pay that super and nominate a date that you must pay it by. If you don't pay it by that nominated date, they'll hit you with a late payment penalty, which will be 25% for the first offence and then 50% if you've previously had a late payment penalty in the last 2 years. That payment penalty is not tax deductible. All right, summarising those consequences, it's actually not as bad as the current regime, other than the fact that you have to pay the super a lot more frequently. All right, a couple of things for us to consider. Obviously, it's cash flow. You're now paying this money with the payroll. And if you're barely scraping by with payroll at the moment, then you're going to struggle to find that extra money to pay the super. But that's the rules and you have to do them. There will be an impact for you on your cash flow for there being 5 quarters in a year. If you're paying quarterly at the moment, and generally you pay your June quarter in the July, then you're going to have to also pay July's super in there. So you're going to have extra super paid within a short period of time, and that's going to impact your cash flow. There is nothing we can do about that other than to start to pay the remainder of your 26 super a little bit earlier so that you can get on top of that cash flow and not have such a burden in July. We also need to consider how this might impact your staff who may be getting tax planning advice. And whilst that's not your responsibility, we don't really want to have some ill will with our staff because we've messed up all their tax planning and they've paid a financial planner some good advice to get that done. And I do a lot of tax planning with a lot of you guys so that your super is maxed out or most beneficial for you. And so this can have an impact on that tax planning, and we'll start to think about that in March, April this year when we're doing our tax planning with you. This is obviously going to have an impact on small businesses moving forward. And I think you can sit here and look at how that impacts on you. Suddenly you're having to pay more each and every payday, but it's also going to impact your clients that are paying you if they're in small business. So if they suddenly become a little bit slower in paying because they're trying to make their super contributions, how is that going to impact your ability to make your super contributions? And that probably is the crux of the biggest risk that we have with this new regime of super. One of the other things to consider is how this will change your operational requirements. You're going to need to update your payroll systems. If you're not using one of the big firms, then maybe that payroll won't be continuing if they've just decided that this is too much, or if it's a cumbersome program, you just might want to change your program so that you've got something that we know works. You'll need to so if we're using a clearinghouse now, if you're using an external clearinghouse to your software, you're going to have to set up the details in your software. You're going to have to set up an applicable bank account. And up to date, this has caused problems with about 3 clients. So we don't have many clients using their software clearinghouse, such as Xero, for example, or QBO. But the clients that we do have that are doing it, we've had 3 clients that have had trouble with their bank accounts where the bank's just not honouring the instructions from the software clearinghouse, super clearing, automated super, to make the payment actually happen. And we've ended up having to change banks or change bank accounts and things like that to make that work. We don't want to find that out in July that doesn't work. So we're encouraging you to get this set up and get it going beforehand. You're also going to have to work out how you're going to manage the responsibility for the more frequent paying of your super. So if we're setting you a clearinghouse payment instructions, or we're using your auto super in your program and we're rolling this out for more and more clients, it creates a PIN or a message to you, usually by a text message, to say, hey, there's an automated super payment, you need to log in and lodge that. At the moment, that can be happening quarterly. Quite a few of you were also doing monthly. Now it's going to happen every single payday. So if you're on leave, if you're on the tools on site and things like that, and you're getting these reminders, you're going to have to make sure that you log in and make those payments, or log in and approve the payment through the automated super. Not a big ask. It's not hard. It's just a time interruption for you, especially if you're on site, if you're seeing clients during the day or any of those other things. Suddenly you've got to stop and log in or log into the portal and to your software and make the payment or approve the payment. And I think that's going to be the other big interruption for everybody. There's been some discussion from people about changing their payroll frequency. So if they're paying weekly now, to drop it back to fortnightly. I'm not a big proponent of that as an idea. Number one, I don't think it's going to help with your cash flow because now you're just going to double it up in the second week. Number two, whether you're having to log into your stop everything and log into your software on a weekly or fortnightly basis is not going to really make a big difference to you come the end of the year. You're just going to have to get into the habit of doing that. A lot of awards might stipulate that it's weekly, and you could end up upsetting staff, right? And if you've got good, happy, aligned staff, you don't want to go upsetting them to change the payroll frequency. The ATO clearinghouse will be retired from the 1st of July. That means that the June quarter super can still be done in July, but I'd really like to think that we have most of you sorted out by then so that we don't have any that has to be paid in July, so that we're ready for this change. Another change that won't impact many of you, but if you've got an employee that works for two employers, and the most common where this happens is with medical doctors who have rights to work in a hospital and they work in a clinic as well. In this instance, their super might be more than the cap for super, and because there's two employers, both employers don't know how much super there is. There are some changes to the deadlines for how you exempt yourself from having the excess super. I'm not going to go into that in any detail right now. I just want to bring it to your attention so that if you've got anyone in that boat, that you reach out to me and we talk about what those consequences are. The thing where I think there will be the biggest issue for the clients that we help with their super is for those that are closely held employees. Now, this is for owners and immediate family of the business. So if you operate through a company and you're paying your wages through there, you're what's called a closely held employee, as opposed to an arm's length employee that you've gone and recruited and put into a role. At the moment, we have quarterly reporting obligations for those clients. We can have the employee taking out a loan from the company, and then at the end of the quarter, we calculate how much is in wages. That can continue. There'll be a little bit of changes to the deadlines and how quickly we need to help. Most of them actually work in our favour, but there'll be some changes to how we manage that. And we might end up getting a few more of you into a system that you're paying the super more frequently than getting to the end of the quarter with the lump sum. But at the end of the quarter, we do a big reconciliation. I think that one's going to depend on how we're managing each and every one of you at the moment, because you're all a little bit different. We manage everything based on your circumstances, and we can still do that, but it will be changes, and it will mean a little bit more interaction with us on a more regular basis than you have now. So summarising how our services will change, there will be changes. Generally, it's tighter deadlines on everything and less wriggle room for all of us in missing any communication between ourselves. You'll need to stay on top of your data more often, especially where you do your own data entry. Managing this for you will add to our fees. How much will it add? I don't think it will be a great amount, because the payroll will be in the software, whether we're assessing you as closely held or we're processing payroll regularly or you're processing the payroll. We can just go in and click a few buttons and generate the system to make the payment for you that you get a text message to approve. It's just going to happen more often, okay? And that's the hard bit that we're all going to have to get used to. I think the short answer is that we will need to discuss your personal circumstances with each of you to see how this is going to change and how you want it to change. It may be that you take on the responsibility for doing the super yourself. It's a few clicks each time you process the payroll, so it's not onerous. And once it's set up and it's working, you can actually probably manage it quite well yourself and then save a little bit in our fees. But we'll reach out to every single one of you. Some of you are going to make the decision it's better for us to do that and stay on top of that deadline for you, so that you're not missing payments because you're on the tools, seeing clients, dealing with staff, whatever it is that keeps you busy each day, and allow us to manage that responsibility for you. I don't know how much it's going to cost, and it will vary from client to client. So we'll have a conversation and we'll work out how we want to manage that. And last thing that I want to bring to your attention is the ATO has a draft practice compliance guideline about how they're going to manage this in the first year. And basically they will assess us for high, medium or low risk. And if you fall into the low risk, they won't put a lot of compliance activity into doing it. So we've got a little bit of wriggle room. But the really key thing from that practice guidance statement is that you're only low risk if you are seen to be making an effort to make it work. And that's all I can ask from you. It's a big change. It's going to impact some people. I think that it will have a very negative impact on some small businesses that are really struggling to survive at the moment. And I don't want you to be one of those. I also don't want you to be impacted by your clients who fall into that category as well. So let's stay in touch. Let's have communication. Reach out to me, Jordan, Dion, whoever you regularly deal with, and let's talk about your super and how we're going to manage this for you. I don't want to leave it until July. I want to be progressively rolling this out with everybody so that you're all on top of it and you all feel empowered and ready and and this works for you, not against you. Happy New Year. See you soon.